Good evening, everyone, and a warm welcome to all the viewers of the webinar being held by the Expert Advisory Committee on recent opinions under India's framework. Myself, CA Parul Gupta, Secretary to the Expert Advisory Committee, and I am joined today by CA Dr. Debashish Mitra ji, who is our Chairman, Expert Advisory Committee and past President ICI, and our eminent speakers, CA Jayant Gokhale ji, CA Vishal Bansal ji, and CA Guru Prasad ji, and our technical head CA SN Gupta ji and our official EAC team. I welcome you all. Now I would request our chairman EAC CA Debashish Mitra ji to give opening remarks. Thank you, sir.
Thank you very much, Parul Gupta ji. Those of us who are hearing me, a very good evening to all of you. We are connected from various places. You see SN Gupta ji, who is sitting in Delhi, along with Parul Gupta ji, Khushbu and the others. They are all part of the Expert Advisory Committee. SN Gupta ji happens to be our technical director. And then, of course, you have people who are sitting in Mumbai, like Vishal Bansal ji, Jayant Gokhale ji, and Guru Prasad ji. I think you are speaking from Visakhapatnam. Right, so you see, you have people from Vishal. So, and I am presently in Calcutta. So you see, we are we are spread all over the country, trying to bring to you the best that we can. Let me just those of us who are hearing me, a warm welcome to all of you on behalf of this, on behalf of the Expert Advisory Committee, and of course on behalf of the Institute of Chartered Accountants of India. One of the first committees which was formed after the institute was formed in 1949. One of the first committees was the research committee. At that time, institute had laid so much stress on research. In 1975, we had this committee called the Expert Advisory Committee. And over the period of time, let me tell you, we have given huge number of opinions. Our opinions are more than 1,600. It has been always thought that, you see, we are a very technical committee, and our opinions over a period of time has had great value. Let me give you an instance. About 3 months back, I was invited by the Deputy CAG to speak on property, plant and equipments before all the Deputy CAGs in the CAG's office. Now, as Parul Gupta ji has just now introduced me, I am also the past president of the Institute of Chartered Accountants of India. I was president in 2020 to 23. But interestingly, they invited me as the chairman of the Expert Advisory Committee. Nowhere did they mention the fact that I was the past president of the institute. And I was quite intrigued. And when I went to speak, they wanted me to speak on PP, India 16, property, plant and equipments. And when I went there, I said that, look, how did you see chairman expert? Because people, they invite me because I'm the past president. They said that, you see, you don't know how important has been the opinions given by the Expert Advisory Committee in the day-to-day functions of the PSUs. The CAGs, they rely on your opinion. And they were saying that the statutory auditors, they are always looking forward to your opinions. And there was this gentleman, he had a huge file in his hand, and he was saying that this file contains so many opinions, which I hope, on some issues I would like to ask you questions, right? Although I was a bit apprehensive seeing the size of the file and that the kind of questions he was going to ask me, but I was very much elated to see the kind of respect that the opinions of the Expert Advisory Committee had in the corridors of the controller and auditor. So over the period of time, you see Gupta ji, people like him, Parul Gupta, Khushbu ji and the others who are there. And of course, these people whom you see as the speakers on your screen, they have made a huge contribution to ensuring that the opinions that we give are well received. As I said, we have given more than 1,600 opinions, and most of our opinions are relating to Ind AS today. We're just looking, it is no longer based on AS framework. In fact, the other day, somebody had sought an opinion from us on AS framework. We're a bit surprised that somebody was taking an opinion on AS framework. So you see, most of our opinions are based on Ind AS framework. If there is a lot of litigation in a matter, and you see, if our opinion is sought, we usually tend to avoid giving an opinion. don't want to get into a litigation where you are having cases before the government authorities and others. Now, those of us who are hearing me might also think that how long does it take for EAC? Because one of the problem that EAC faced earlier was the feeling was that we take too long in giving opinions. Today, if you come to EAC and seek an opinion, we will try to give you within 2 to 2.5 months, right? And we shall try to make it quicker than that, mind you, because since the quality of opinion is so very important, we have to take a bit of time to seek details, and then the team, the EAC team, they get together and try to form an opinion. And mind you, after a draft opinion is done, let me tell you, it then comes to the committee. Committee has Jan Gokhale ji, Guru Prasad ji, Vikas Bansal ji, and so many others in the committee. And then comes the debate over the opinions. There will be 70% of the people who will be agreeing with the draft opinion, and 30% of the people who will not be agreeing with the draft opinion. And then for a person who is the chairman of the expert advisory committee, I need to bring all the skills that I have as a president of the Institute of Chartered Accountants of India to have some kind of unanimity. Because here in the expert advisory committee, let me tell you, nothing gets done based on majority. We try to have a unanimity in opinions. You might also ask me that does every opinion that you give, is it always accepted by the querist? Parul Gupta ji will correct me if I am wrong. Only about 2 to 3% of the opinions that we give come back for a review to us. Maximum 4% come back. Others are all accepted, right? So they come back for review. Now you might ask me, how can you review an opinion if you have given the opinion? Isn't there a conflict in that case? So what we do is this: whenever an opinion comes back for review, the office does not review that opinion. Because the office has developed its opinion to ensure the independence, we don't involve the office. We also do not go to those members of the expert advisory committee who were present in the meeting in which the opinion was taken, the original opinion, which is now up for review. What we do, we seek 2 or 3 members of the committee who were not present in the meeting when the opinion was taken, so that total independence is there, as to whether we should go for review of that opinion or not. And needless to mention, the chairman and vice chairman of the committee have nothing to do with any kind of review decisions. So when these 2 or 3 people who are not present in the meeting tell us that yes, as per the review rules, you should go for the review or you should not go for the review. And let me tell you, in 99% of the time, the opinion comes that no review required because the original opinion is correct. 99% of the time, let me tell you. Then we write a letter saying that, whatever opinion that we have given, we stand by it. So the point I was trying to make before those who are listening to me is that we have a transparent process in place. We have a top-class committee whose committee members and the staff that you see here, all of them are, I believe, chartered accountants. The staff that you see here, and all of us who are here, all chartered accountants. And the opinions that you give are extremely debated, and the insights that we get, sometimes I feel, very privileged that I am part of the discussion which is taking place when the opinion is finalized, because the quality of discussion is so high, right? So those of us who would like to use the EAC opinions, go for the search engine that we are having. We have more than 1,600 opinions. We have got this compendium of opinions volumes, those are in the hard copies. You may also take them, right? But use the search engine, it's better. And spread the word that EAC, and I'm sure after today's webinar, you'll realize that we are the top class committee of the Institute, and that if you want an expert opinion, your first port of call should be the expert advisory committee of the Institute of Chartered Accountants of India. With these words, I welcome all of you to this webinar, and I have no doubt you will find the deliberations extremely interesting, enjoyable, and enlightening. So, you see, happy learning to all of you. Thank you.
Thank you, sir. Now I would request CSN Gupta ji to give a brief introduction of our speakers.
Thank you, Parul. Thank you, Chairman, sir. Thank you, Chairman, sir, for bringing EAC to a different level, different tangent. Thanks for your energy and thanks for guiding the entire office, sir. And you have really brought EAC to a very different level. As you just mentioned, the kind of respect we get outside because of EAC, it's really incredible, sir. Thank you very much, sir. So today, sir, we are covering 6 very important topics. The first is on the capitalization of ATS charges due on intangible assets under development, accounting treatment of shareholders' loan, accounting for leasehold land and applicability of India's 116, consolidation of financial statement of Section 8 companies, classification of provision for doubtful debts, no longer required written back as other income, accounting treatment for energy service companies project, that is smart metering program project under India's framework. To cover these 6 very important topics, we have 3 stalwart of the profession, CA Jayant Gokhale ji. CA Jayant Gokhale ji has a professional experience of more than 40 years. He served as a Central Council member of ICI for 12 years, from 2001 to February 2013. Over the last 2 decades, he has been closely associated with numerous academic activity, including the framing and adoption of accounting standards, many of India's as well as standards on auditing. He has been chairman of EAC for 2 years in past and has also been a member and special invitee of the committee for many years. He has also been a part of various committee board of ICI in one capacity or the other, such as AASB, FRRB, PRB, etc. He has authored 2 publications on taxation. He has a huge, incredible contribution in various technical committees of ICI, sir. C. Jayant Gokhale ji, I welcome you. C. Vishal Bansal ji, our second panelist for the day. C. Vishal Bansal ji is a chartered accountant with approximately 25 years of professional experience. He is a partner with one of the large chartered accountancy firm and is a leading technical in the leading technical department of the firm. He is advising client on IFRS India's matters. He is currently a special invitee in expert advisory committee and has also been associated with EAC in past in various capacities. Previously has worked in the technical directorate of ICAI. Thank you, Vishal Bansal ji, for your contribution to ICAI.
Thank you, sir.
The moderator for the day for this particular webinar, CA Guru Prasad ji. CA Guru Prasad ji is a chartered accountant having 25 years of experience in handling audit and assurance assignment for major public sector entities and private sector entities. Presently, he is a special invitee of EAC. He has experience of working in different business segments, both as an auditor and as a consultant to the management, and has expertise as a member of executive board of NPU as well. Thank you, CA Guru Prasad ji. Now with this, I hand over to Guru Prasad ji for further deliberations. Thank you very much.
Thank you, sir. Thank you very much for handing over the proceedings. Without wasting a lot of time, I would like to go ahead with the presentation, and since we have 6 opinions to discuss, we will straight away get on with the topic on hand. Let me share the screen so that everybody can see the presentation. Yeah. The first topic for today's evening webinar is capitalization of ATS charges due on intangible asset under development, ERP. The facts of the case are like this. The company is engaged in manufacturing and marketing of fertilizers and all allied products. The company has awarded the contract to Messrs. Tech M for implementation of SAP ERP solutions at the company for a total value of rupees 76.73 crores, which includes IT infrastructure and cloud hosting, ERP license annual technical support, ATS, ERP application support, etc. As per the agreed terms of the work order, the implementation of SAP ERP solution was to be completed within 12 months from the date of work order, that is 29th July 2021. However, implementation of SAP ERP solutions got delayed and implementation is still under progress. Accounting treatment by the company. After the start of implementation of SAP ERP solutions at the company, it has incurred an amount of rupees 30.44 crores up to 31st March 2023 and has capitalized the same, including ATS charges of rupees 7.42 crores based on value of work executed as per the terms of contract. The year-wise breakup of cost incurred is as under: ERP SAP less than 1 year 4.10 crores, 1 to 2 years 4.44 crores, 2 to 3 years 21.42 crores, more than 3 years 0.48 crores, totaling to 30.44 crores. Work order details relating to ATS. The scope of work order with regard to ATS ERP license annual technical support ATS is due on 1 year after delivery of license up to 5 years. No invoice has been raised Messrs. Tech M for ATS and no payment has been made to Messrs. Tech M. However, based on principle of conservatism, a provision of rupees 7.42 crores, rupees 3.73 crores per year is being made in the books of account and charged to capital work in progress under the head intangible asset under development. Government audit observation on the annual accounts for the financial year 22-23, the company has to release ATS price to the tune of rupees 7.42 crore for the unimplemented period of ERP project, which had not given any benefit to the company. Further, ATS was to be paid during operations and maintenance phase, which was not the part of development or implementation phase. Moreover, ATS has to be paid on yearly basis, which is of recurring nature and not directly attributable to cost of development of ERP. Hence, the same should not be capitalized under the head intangible asset under development. Thus, it has resulted in understatement of provision for expenses and overstatement of profit by rupees 7.42 crores. Management replied to the audit observation. ATS is in relation to the above set licenses on which ERP development, testing, etc. is still continuing, as the ERP is still under development stage, and ATS to be paid is in relation to license procured, which are currently being used and will continue to be used for development of ERP till milestone of go live is achieved. Expenditure to the tune of 7.42 crores on ATS has been correctly recognized under intangible asset under development. Whether the capitalization of ATS charges due on intangible assets under development ERP in books of accounts of the company is in accordance with the provisions of Ind AS 38 or not. So this was the question that was raised to EAC, and I request CA Jayant Gokhale to deliberate on this particular opinion. Over to you, sir.
Thank you, Guru Prasad ji. And of course, like all problems that are referred to EAC, there is usually a mix of fact and the standard which is involved, because facts also play a big role in understanding what exactly needs to be done in a particular case. Now, in this case, I would like to highlight, what we try to do. And first of all, yes, before I proceed, thank you, past President Sir, and for the EAC committee for having me here. It's a pleasure and a privilege. But let me jump straight into the technicals. So, as I was mentioning, the capitalization of intangible assets in this particular case, two important factors that have possibly raised the issue so far as the audit observations by CNEG are concerned, and which will be also important for us to understand, is the use of the phrase annual, what is the phrase? ATS is annual technical support. Now, basically, what one feels is that support starts after installation. That is the general concept. However, one has to be familiar with a little bit of how the software industry often uses certain terminology. And those of you who have worked in this field or worked in regard to capitalization of charges, etc., you will understand that when one is developing or customizing, one may not be developing per se, but customizing an existing software like ERP, there is a huge amount of work that requires to be done. And as is apparent from the query, it has taken more than 12 months and possibly even more than double the time. But none of this can be done without acquiring the necessary license and the cloud servers and so on. So there are two aspects to the question that have been asked, because if one looks at it, no bill has been received. So whether the claim for payment of that 7.43 crores has been made by the service provider, answer is no, claim has not been made. Perhaps because the job is not complete in terms of development and the payment is to be made post the UAT, as it is called in software field, user acceptance testing, perhaps the bill has not been raised. Notwithstanding that, the software licenses have been provided, have been utilized. The cloud server space has been utilized possibly for what they call the test server in these sort of situations. And therefore, what really happens is that the meter for the company is already running. So first and foremost, no bill raised. Should the expense be booked? Answer is, I'm trying to break down the problem. Answer is yes, for the reason that this is a time-related cost that as I'm using the facility of server, cloud, software license, etc., this cost is going to be incurred. The second part is, even though the bill is not raised, should it be recognized? Answer again is yes, because there is a contractual obligation to do so. Thirdly, having said that, does it, and that is where the CNEG's objection seems to be, that it is to be paid subsequently. That, to my mind, the time of payment is not material. Contract may allow you deferred payment terms. That does not in any way dilute the manner of recognition of the income. And then one comes to the important part, that is it appropriate to capitalize this? Because that is the crux of the problem that is being debated. In the sense that is where, if you see the presentation that has been put up by Mr. Guru Prasad, since this is something to be paid at the time of subsequent to the operation and development, operation and maintenance phase, the CNAG's approach seems to be that this is not something that is capitalizable. Now, here I would like to take you specifically to the provisions of Ind AS 38 and what has been the factor influencing the committee. And there are a few specific points I would like to really bring out to your attention. One is that, in these sort of development projects, the testing, etc., takes a significant amount of time. The development amount is quite significant, and the case actually says that even though 12 months have passed, there can be much more period that may be taken up. So that is first aspect. Not just that, why is it important for the company to continue to pay the ATS charges? Because as has been given in the data, it is not just the license, but also as the licenses, the ERP licenses actually keep developing newer versions. Like those of you who are familiar with iPhone, etc., you will see continuous upgrades to the software are going on. And if you don't upgrade and use the latest patches, then your software development or customization will fall short of what the target is. So these patches, upgrades, updates, as they are called, will have to be continuously implemented or applied and installed. So to that extent, and then one goes to the real crux of the standard. So para 8 of the standard AS 38, which deals with intangibles, what does it say? It says that the development of certain products, what is to be capitalized is that all the expenses incurred during that process, the words used are before start of commercial production or use. Now, in the case of a software, we are not looking at a physical output. We are looking at use of the software for commercial utilization. And again, I will draw attention that in the case of software development, and again, sorry, not development, customization. When it comes to customization, the entire use is not started because they test all this and do the development on what is called a test server. It is never, so there are three phases very broadly, that there is a test server and development stage, there is the user acceptance testing, and only when the software passes both these tests, the customized software, then it will be reaching a go live situation. So just like in the case of machinery, when we say that there is a trial production and there is a testing and there are corrections made, and then there is commercial production, that is what we understand in the concept of physical production. In software field, when we say commercial production or use, it will mean that post user acceptance testing, when it goes to go live situation, that is where the test applies in intangible assets. And in the given case, it is very apparent that they have not even reached the stage of user acceptance testing. They are still making customizations. So to that extent, para 38 is very clear, and the facts as given to the expert advisory committee showed that these facts need to be taken into consideration, and the ERP is still under the development phase. And therefore, until and unless that stage is reached, this expenditure would go into the concept of development, which would require to be capitalized. Now, just to give you a simple example, the CNAG also had one other point, that these are annual technical support. The word annual tends to create a doubt in your mind that these are recurring charges. How can you capitalize recurring charges? But as I said earlier, in the field of software, the annual technical support also includes license fees. That is one aspect. And to give a parallel example, let's say that a huge project, let's say in a very major industry like fertilizer or something, it requires to be tested to see whether it is meeting the production standard, which is saying that, say, 80% production is achieved, of capacity utilization is achieved. It is possible that a significant amount of power, maybe by way of gas or electricity or steam, may be used. Now, electricity, if it is used and is costly for that sort of a plant, one can say that electricity is an ongoing cost. Electricity is billed on a monthly basis. So is it not an annual charge or a monthly charge or a daily charge, depending on a usage? Answer is yes. However, if that electricity were to be used in trial run production, then that is capitalizable. Never mind the fact that in normal course, electricity is a revenue cost. So similarly, even though post-development and after user acceptance testing and post go live, the ATS charges will undoubtedly be revenue costs. The expert advisory committee considered, and what was specifically considered was with reference to para 38, and also a very interesting para which has been cited by the expert advisory committee, that at the first instance, should it be capitalized? The answer was clearly yes, that it should be capitalized because it is meeting the criteria specified in para 38, sorry, I'm forgetting that para number, the definition of para 8 of AS 38, para 8 of 38. Also, there is another point which has been brought out by the expert advisory committee, that in para 71 of the same standard, it has been mentioned that once you expense certain item, thereafter you find that the production is not still going on. Hypothetically, let's say it may actually not work. In such a case, you cannot subsequently reverse those charges and say that, that means if you have expensed off those charges and then subsequently you realize that some fine tuning is necessary. So in such cases, you cannot reverse. That is provided for by para 71. So if you read all these things together, it is very clear that the action or the approach followed by the company was appropriate, and therefore the expert advisory committee had no hesitation. There were two factors which have been cited in the opinion, that ATS was to be paid during operation maintenance phase and in the development phase. There was no distinction between which phase you are making. And even though it's an annual cost, it does not make a difference to the actual nature of the cost. So again, I will use reference of the standard. Any cost incurred till the intended use is achieved has to be capitalized, and intended use is still not achieved. So that is the broad principle that has been followed, and therefore the EAC came to the conclusion that this cost is correctly capitalized and there is no reason why that should not be done. So that is broadly how the EAC gave a very detailed consideration to these issues and agreed that it requires to be capitalized. Bansalji, if you have any comments to add or some points to contribute further, please do so.
Yeah, I think Gokhleji very detailed and very good summarized and explained. I think I was also enlightened again while we have gone through the discussion. I think I would just like to add, I think, a few points. First of all, this issue of SAP, etc. Now, there are many companies that we have seen in practice are doing this kind of thing. So in that sense, it's a very relevant opinion. In fact, when I was thinking that if I have to pick one relevant opinion, I could not find one. All six are equally relevant in that sense. What the expert advisory committee has chosen for today. Now, and if I come to specifics, while Gokhleji has explained, I think almost everything in the opinion and reasons behind it, I just would like to highlight paragraph 9 of the opinion, which is particularly some of the matters where EAC had said that these are not really examined because that's the facts given by the querist. And I think in a normal course, when we are applying this opinion, this could be very relevant for the management as well as the auditors to look at it. Now, the first aspect which was coming is whether this asset is an intangible asset as such, or it is kind of something else, has not been looked up by it because the company was already doing the rest of the expenses as intangible asset under development. But so it was presumed that it is intangible asset definition will be met once this is there. Now, if I have to really look at it, why this question could be relevant in a practical life. Now, there are many times now the companies are moving to the cloud servers where it is not like a specific dedicated source server or a software license, but you are sharing that license server space with many other companies across the board or many other users. So there it could potentially be either a lease or it's a service. But now that issue was not there here, which could be requiring evaluation in a practical scenario. Second aspect, obviously, is that under India's 38, Gokhleji has briefly touched upon. And if you look at it, the capitalization criteria is a stringent criteria in terms of that you have a reasonable resources to complete, the project will be completed, economic benefits will be generated, etc., etc. So those criteria have to be demonstrated once you start putting any expense under intangible asset under development. Now, again, the management has already done it, and obviously that was not under challenge. So EAC had not gone through it. Third aspect, which EAC has also put in, and I think which could be relevant. Originally, the project was stretched to be 1 year, and now it has gone beyond. And obviously, as Gokhleji has explained, these projects are never simpler. There could be a much more complexity. But the point which was there, is this a delay because of the work was going on? Actually, the work was going on. There were some administrative and other works required to complete the asset, or there was kind of a work has stopped and there were abnormal delays. And on that sense, obviously, as an auditor, as an accountant, we know that if some part of the work is stopped, there is no activity going on, there are abnormal delays, the cost for that period cannot be capitalized, and that period costs have to be obviously charged to profit or loss. So in this case, the EAC has again presumed that there was no abnormal delay, the cost activities were going on, and consequently the work was going on. So I think these were the three important aspects which EAC has not looked at it because the querist has not asked, and they were assumed. And then obviously other aspects in terms of annual technical support, as Janji has already explained in detail, that this could be capitalized. So I will not go this thing, because Gokhale ji has already explained in detail. So I don't have anything further to add. Yeah. Guru Prasad ji, anything else?
In fact, Guru Prasad ji, before you come in, one other point, which of course rightly you mentioned in para 9 itself, Bansal ji, you made a reference to that. You touched upon that point fleetingly, that while nothing has come to our knowledge, the committee has emphasized that if there is a suspension of the project, then those costs do not get capitalized. But here there is no evidence or statement of suspension. Rather, as was rightly referred to by Bansalji, there is a statement that due to some administrative issues, delays have taken place. And I have been part of such projects where, because of changes in the ERP software itself, certain reprogramming has to be done, etc. But that is not suspension. A suspension that, for example, the company starts doubting whether one is going to at all implement this because the cost is now going haywire, or because they feel that the company is not rendering the appropriate service, so whether we should cancel the contract or something of that nature. No, nothing of that sort is on record, and therefore EAC has rightly highlighted that there is no suspension, there is no statement or indication of suspension, therefore it is part of development. Yes. Guru Prasad ji, over to you.
Thank you, sir. Thank you. As such, the opinion has been thoroughly explained by Jayan sir and Vishal sir. Jayan sir, you have rightly pointed out that whatever be the nature of expenditure, be it a revenue nature or capital nature of expenditure, but even if it is a revenue nature of expenditure, particularly in cases where we are in-house developing an asset, then certain indirect expenditure or revenue nature expenditure also, we capitalize them until the asset comes to the level of operation that management intends to get it to. So in this current scenario, though the ERP solution is being developed, it did not reach to that state where management is happy with the operations of that particular ERP solution. So whatever expenditure that gets incurred, be it staff costs, employee costs that are directly involved in developing that particular software, all that would go and get capitalized. So that is one important point that you brought out. Be it the nature of expenditure is not relevant here. It can be a regular recurring expenditure which happens year on year or monthly basis. But what basically depends is the timing of capitalization. Until the capitalization is done, all those recurring expenses also get capitalized, which is what we have brought out, which is also clearly stated in the opinion. And then the other important aspect when it comes to looking at all EAC opinions, EAC, when they are giving opinion, they generally presume certain things and then they do not take certain things under purview. So these paragraphs, we have to look for them and then see, because whenever we are applying these opinions in our regular practice, when we are doing our audits, so these are the few paragraphs which we have to see, because those would be demarcating the opinion and then the facts with the ones we have factually on hand when we are conducting audits. So Vishalji rightly pointed out that EAC did not go on to check the correctness of provision, whether liability is there, should the provision be made, all those things the EAC did not go into, because that was not the moot question here. It is presumed that the provisioning aspect is correct, company is liable for that expenditure, so provision has been made. So there is no question or discussion on that particular aspect. Likewise, also on suspension aspect, there is nothing indicating that there is a suspension in the project which would require suspension of capitalization of expenditure. Likewise, even the other point that Vishal ji brought out is the question of capitalizing the intangible asset, whether intangible asset needs to be capitalized or not. That question also is not moot question here. So when we see these opinions, we have to see what is the moot question, and then what institute is excluding itself from opinioning, and then what are the presumptions that the EAC has taken. So here EAC has presumed that the obligation is there and provision is to be made. The only question is whether we have to capitalize it or not. And it has been very well given in the opinion and very nicely brought out by both our panelists, sir. Vishal sir and Jayan sir, very nice that you have brought out all the key aspects of the opinion. If there are any questions from the audience, you can post them in the box, and then those questions will be routed to us, and then we will ask the panelists your questions on the topics that are being discussed. And sir, would you like to add anything, Vishal sir or Jain sir? You may please add, otherwise we will move on to the next query, sir.
Can move
No,
on to that.
nothing from my
next
side.
item.
Okay, sir. I'll share my screen then. Sir, my screen is visible now?
Not yet. No, not yet.
1 second. Now,
Now,
sir?
now coming on. Now coming on. Yes.
Thank you, sir. So the next issue on hand is accounting treatment of shareholders' loan provided to joint venture company under Ind AS framework. The company is engaged in refining of crude oil having a refining capacity of 3.0 mmtpa. The company is jointly owned by O Limited, Government of Assam and E Limited. The board of directors of a company earlier approved shareholders loan amounting to rupees 650 crores to be given to its joint venture company A Limited for the implementation of biorefinery project. The above shareholder loan is provided under two different agreements for an amount of rupees 261 crore and rupees 393 crores respectively. The company has distributed an amount of rupees 443.50 crores to A Limited in various tranches. The salient features of both the shareholders loan agreements are as under. Loan number 1, I'll just read out first, then we will go on with loan number 2. Nature is unsecured, repayment at once at the end of 15 years from the date of agreement, that is 5th August 2035. Rate of interest, annualized term loan interest rate of PNB plus 0.85%. Shareholders loan interest rate shall be subject to changes in the term loan interest rate. Interest accrual and payment, interest up to commercial operation date COD shall not be accrued and paid. After COD, interest will be paid out of project cash flows on yearly basis at the end of every financial year till repayment of loan is done. And with regard to the second loan agreement, the nature is also unsecured. Repayment terms at once at the end of the 11 years from the commercial operation date. Rate of interest, annualized term loan interest rate of PNB plus 0.73%. Shareholders loan interest rate shall be subject to changes in the term loan interest rate. Interest up to commercial operation date shall not be accrued and paid. After COD, interest will be paid out of the project cash flows on yearly basis at the end of every financial year till repayment of loan. These are the terms of, briefly the terms of loan agreements. Accounting treatment applied by the company. The company calculated the fair value rupees 400.54 crores of loan disbursed, rupees 443.50 crores till 31st March 2023. So loan disbursed is 443.50 crores and fair value calculated by the company is 400.54 crores, resulting into difference between fair value and transaction value rupees 42.96 crores. The fair value of the loan rupees 400.54 crores has been presented as financial asset, and the difference between the transaction value and fair value has been presented as investment in joint venture. Interest on loan rupees 39.34 crore up to 31st March 2023 has been calculated considering fair value of the loan from the date of disbursement. Interest income is reflected as other non-operating income under the head other income in statement of profit and loss of the company with corresponding addition to financial asset and added to loan value. Auditor's observation, non-current financial assets loan includes rupees 39.34 crores as interest receivable on shareholders loan given to Messrs. A Limited. According to shareholders loan agreement, up to COD of biorefinery, interest shall not be accrued and paid to shareholders loan. Further, Messrs. A Limited has not yet declared COD as overall physical progress of the project was only 85%. In view of shareholders loan agreement, company would not be able to recover rupees 39.34 crore from Messrs. A Limited as interest is not accruable up to the date of COD. Accordingly, a suitable provision should be made in books of accounts to cover the same. The query here, whether the accounting treatment of shareholders loan made by the company is in line with the provisions of applicable in AS, whether as opened by the auditor, company is required to make suitable provision towards recognition of non-realizable interest up to COD from shareholders loan extended to joint venture company. This is briefly the issue that has been sent to EAC for their opinion. I request Vishal Bansal sir to deliberate on this particular opinion. Thank you, sir. Over to you, sir.
Yeah, I think again, this opinion is very relevant, particularly considering like in India, we have many group structures and we have seen many of such loan arrangements amongst the group companies. I think in this case, the first point, which obviously the EAC is an important point to note, it is that EAC has looked at it, this issue from the perspective of the financial statements of the company, and particularly it has looked at it only and only separate financial statements of the company. It has not looked, and it is specifically said that consolidated financial statements perspective, it has not been looked at it. Obviously, there are other aspects also which EAC has not looked at it, but I think this distinction of separate and consolidated financials is very important, because in console there could be an, I don't know whether it was actually a joint venture or a subsidiary, or and what kind of accounting is done in console. Let's say even if it is consolidated, loan may not be there, or even if it is an equity method, there could be intra-group eliminations and other aspects. But yes, issue was not raised from consolidated financial statements perspective. EAC has not looked at it from consolidated financial statements. Amongst the other points which EAC has put, this was one important limitation to my mind. Now, secondly, if I really look at it now, in this case, if I was to really look at it from the loan perspective, broadly the construct is that there are the company who is the shareholder is giving a loan to its joint venture investment company. Obviously, it carries an interest, but interest will start only after the commercial operation date happens. And here, one important point is sometimes it could happen that while the interest will accrue for the period of construction, there will not be payment. Now, in this case, the fact was that there will not even be an accrual of interest. So it is, let's say, for 2-3 years of construction or whatever period it takes, it will be completely interest free. And so that was another important fact. Now, coming to the standards, and obviously the first point is this is a loan given, it is not an equity investment. The standard which will apply to this loan by the company who is giving the loan is Ind AS 109. It is not an Ind AS 27 equity investment which can be measured at cost. So under, we have to look at this issue from Ind AS 109 perspective. Now, under Ind AS 109, the first point is that any financial asset or financial liability, in this case it is a financial asset, needs to be measured on day one at fair value plus transaction cost. Generally, except if it is an amortized cost. So in this case, the loan has to be measured at amortized cost. That's the first principle. The second is standards also say that normally if you are the two independent parties are transacting, then the transaction will be generally considered at fair value, because there are two independent parties transacting. But if that is not the case, then one will have to look at it, why that fair value difference is arising, etc., etc. And the standard has also specifically said that in case of a related party dealings, it may not be at a arm's length. And again, we are dealing with here an accounting perspective related party transaction. We are not, or the EAC is not looking at it from a Companies Act or a SEBI compliances perspective. That's a separate matter. Obviously, that should have been insured. Now, so in this case, it was a related party loan. And other principle, that's where it appeared like it may not be at arm's length, and it also smelled like not at arm's length, because there was a certain period for which there was no accrual of interest. Third point, the standard also says that in case of fair value difference, you will ignore it unless until it is based on either an active market like a listed share, or you could compute it based on observable inputs. Now, in this case, if you are to really look at it, just to calculate the fair value of the loan, how you calculate, you know how much cash flows it will give after in form of interest and principal repayment and after period. So that cash flows are clearly known. Second is you need only a market rate of interest to do a DCF. So the interest rate could be clearly observed. So using that, one could compute the fair value of the loan. And now the fair value of the loan comes to be lower than the amount which has been disbursed. And I think while the figures could be bit of rounding off, I'm taking, let's say it was a 440 crore amount given. And when the computation came, so the loan was computed to be 400 crore. There is a 40 crore delta and there are no transaction costs. So the company will recognize the loan asset at 400 crore and the cash outflow is at 440 crore. So where should this delta of 40 crore be going? That is the question or the next question to be addressed in this case. Now on this, the standard was saying that normally this kind of differences goes into P&L unless until it could be justified through another asset. And obviously you have to look at the substance of the transaction. And I think that is where the EAC looked at it, actual substance of the transaction. And that is a very important opinion in this context, I think, what I really believe. Now, in this case, the point was that no company will give this kind of off-market loan to a third party. Okay. And expect nothing in turn. Now, in this case, the company is giving a loan to its investee company. The company is already holding its equity investment. Now, even if I am not getting a full interest benefit on the loan, there will be an interest benefit indirectly coming to me through the equity investment. While I have given 40 crore, etc., extra, there are no direct equity shares coming back to the company, but it will still, the existing equity share value has gone up. And hence the company will get that benefit and it can actually control that benefit. So considering that relationship and substance of the transaction, the EAC concluded that the accounting entry which the company has passed in terms of loan asset debit 400 crore, investment or equity investment in joint venture debit 40 crore, to cash or to bank for 40 crore is appropriate. And I think this investment addition was a very important clarification and important decision in terms of where it should really be put. It can't be just one goes based on India's 109 principle saying that there is no share issued, hence it cannot be addition to the investment. I think that's very important decision which EAC has made in this case. So that was one point which obviously made. Now, second is, if you really look at it now, the loan is appearing at 400 crore and ultimately the company will get cash flows based on, after considering interest-free period, 440 plus interest. So what you do is that you accrue interest on 400 crore now, assuming the final cash flows, and consequently that is what the interest income the company has recognized. And here the loan will obviously, because it's an interest bearing loan where your company is getting a fixed cash flows in terms of interest and it will continue to recover that interest. So from a financial asset classification criteria, which is based on my receipt of interest reflects recovery of principal and interest. And secondly, the company is expecting to hold the loan to maturity. Those were met. And consequently, now instead of presuming 400 crore loan and then accruing interest, because the loan has now been recognized at 400 crore, the interest accrual is happening on that. And consequently, that's where that interest income is arising and sitting in the P&L or wherever it has to be sit as per the standard. And consequently, loan amount is increased. And EAC found that accounting also by the company also to be appropriate. Now, third question was that this interest, which has been accrued during construction period, now as per the loan terms, it has not been provided. So is there a need to provide for that interest as the CAG was or the auditors were suggesting? Now on this, if one was to really look at it, the moment company recognized the loan at fair value at 400 crore instead of 440 crore, the entire construct of the loan has undergone change. That 40 crore has already been reduced from loan value. And ultimately now, based on the market interest rate, it reflects the final cash flows which the company is actually going to realize. And here, if one was to look at it, there is no loss in the value the company is happening. So if the company is confident the cash flows which are agreed as per the loan term, they will be received. There is no uncertainty on those things, which is a separate evaluation by the management and by the auditor. So just because there is no cash payout or there is no interest accrual or payout will not cause the impairment. That's what EAC concluded. And obviously, again, because of the entire present value and the construct has changed, is undergoing a change. Now, I think so that's what the EAC concluded. Now, only other incidental point I would like to make is in this cases, whenever dealing with it, that cash flow testing is important. Now, another important point which one should always remember, that equity investment has got a value added in terms of 40 crore. Now, the let's say equity investment was earlier sitting at 100 crore, hypothetically. Now, it has just become 140 crore. So, because of this equity investment going up, is there any potential impairment? Do I need to test that for impairment? Should be definitely separately assessed. That may or may not be there, but yes, that will be tested. So, I think that is the only additional point which I had, and obviously the EAC has explained all these points. Now I will request Jayant Gokhale ji to add further points where whatever they have on,
Yes.
he has on the opinion.
Yes, thank you. Thank you, Vishalji. You have brought it out very nicely. In fact, that last point was exactly the one where we must also clarify to the listeners that it's not that the EAC or the persons participating in it are unaware of this, why this impairment issue. If you go through the text of the EAC opinion, it is nowhere mentioned. The reason being that EAC will answer only what it is asked. And rightly so, because there is no indication of impairment today. Therefore, that issue has not been tackled. But undoubtedly, that issue is very important, because once you are on this concept that you are fair valuing it and you are therefore adding to the value of investment made indirectly by virtue of a sacrifice that the parent has made. I also agree, Vishalji, that this is a very important point. But I would also immediately stress to our viewers that please do not try to apply this thought process where it is not a related party, because there the answer could be different. If it is not a related party, or if it is not officially fitting within the definition of related party, there are some distant relatives to whom you are advancing a loan, the same logic may not apply in this case, because we are very prone to, our businessmen also are very prone to plan on the basis of something by applying some statement and trying to build a castle on basis of some slight opportunity that one may get. So this is a perfect illustration of where the distinction between our accounting standards under the Companies Act, which are prescribed by ICAI, which are not based on fair value, and those that are based on fair value, how standards. Obviously, the EAC considers only specific cases, and therefore this case was under the Ind AS, and therefore the opinion has been rightly given and rightly explained also by Vishalji. So nothing more to add. I think you have brought it out perfectly well. But I thought these two words of caution are careful. Do not apply this where it is not a related party. Things can be different. And then the accrual concept also. And if it's under the company law standards, which are other than Ind AS, that is as prescribed by ICAI, fair value not being the basis, the accounting treatment will be entirely different. So that these two words of caution I thought I must mention, although they come from your observations also, Vishalji, but rightly, since the EAC has not addressed that point, it has not been dealt with specifically. Over to
I
you.
agree. I completely agree, Gokhale. And I think just to supplement, not only a unrelated party, even the nature of a relationship could change the accounting treatment. So one can't generalize this opinion on a very larger point. And only one more supplement which I would really like to make is that once you do all this accounting, like loan is appearing at some different value, investment 40 crore suddenly gets added, all these adjustments do not happen for current tax purposes. So, and mind it, under India's, the deferred tax accounting is not based on the P&L approach, it is based on balance sheet approach. So it creates a lot of temporary differences. One will have to also look at it, what tax deduction will happen, not happen, and consequently there could be lot of additional deferred tax accounting implications, which the EAC has not looked at it, and obviously one will have to really look at what is the tax position of the company, how these amounts will originate and how they will reverse, and consequently may or may not be required to make deferred tax entries. And I think here I'm specifically emphasizing may or may not be required. So it is not that there will definitely be there, but yes, it could be there.
Yes.
Thanks. Thank you, sir. Particularly the main aspect that we have, that Vishal sir has brought out. One thing I would like to once again highlight is particularly when a loan or anything is from a related party, then we will have to check out whether it is at a fair market arrangement, or are there any benefits that are getting transferred between the related parties. So had this loan been a normal loan from a bank and there is a moratorium period, we wouldn't have looked at it in this fashion, because it is a loan coming from a shareholder, and then there are certain benefits given as a, under COD period, there is no interest levy and all that. Immediately under 109, this fair value thing kicks in, and then all this evaluation has to happen. And Jain sir also rightly pointed out that we cannot compare this from contractual point of view, since contractually there is no requirement for making a payment of interest during the COD period. There shouldn't be any interest liability that should get booked or interest income that needs to be booked. But here, when we apply fair value method, and then under effective interest rate method, we will have to recognize this interest. And then it gets evened out over the period of tenure of loan. That is how in the Ind AS it works. So basically the difference is only in the understanding of between what is between contractual terms and what is required under Ind AS. So under contractual terms, there is no interest liability. But when we apply this Ind AS and fair value mechanism, and then when effective interest rate method gets kicked in, then this interest recognition becomes important, and which is why EAC also has opined that the treatment given by the company is in line with Ind AS. And the issues, they get really complicated when other questions are also asked along with it, like Vishal sir said, with regard to deferred tax treatments and all that. But all that has been not been dealt with, because those questions are not asked to EAC. So naturally, they have not been dealt with. But one important aspect is when we apply this effective interest rate method, contractual terms, and then when you compare it with accounting, it may not match exactly, because in an effective interest rate method, we will have to recognize it in the first year also. So we have one question from the earlier opinion that we have discussed. I would like to ask the panelists to kindly deliberate on the question that has been received from audience. The question is, how can the concept of economic benefit be adjudged from an SAP implementation program? So here what the audience is asking, one of the audience is asking is basically, we won't recognize any asset unless there is an economic benefit flowing to the organization in future. So in implementing SAP or in developing an SAP, how is it that this concept is addressed? That is what the question is about. Sir, Vishalji, if you can start up with the discussion on this particular question.
So I think Guru Prasadji, obviously the question which I could understand audience is asking is, SAP is not a directly revenue generating asset. Now, if I look at the SAP is more for accounting. It does not contribute to the business. It does not directly generate revenue, or it does not directly save costs. And that's where is the concept of economic benefit. Now, I think probably if one really looks at it, while the SAP may not be directly contribute, it may not be a directly revenue generating asset. But my question will be, can the business really be run, or it helps really in the business running more efficient and effective way? And obviously the companies invest so much in all this. In fact, there could also be the cases where people use even SAP directly for invoicing and so many things also. So it could even be revenue generating. But even if I look at it purely as an accounting software, it is still very much required for efficient conduct of business, for effectively managing its operations. And it is something which a business cannot really survive or thrive. So it is required for the entire running of business effectively, efficiently, and in that sense, there is obviously a benefit. And I think again, if I probably try to draw a little bit analogy in a PPE standard to environmental assets or enabling assets, that what we discussed it, they may not directly contribute to the output, but their existence is as much required for the other assets to run effectively, efficiently. And without that, ultimately you can't manage all your business affairs and run efficiently. So definitely there is an economic benefit, and one can't look at economic benefit only in terms of that it has to directly go and generate revenue. Otherwise, probably one would say that in many cases, the chartered accountants are doing all this accounting, auditing jobs. So where is the cost? I'm not really questioning, but I'm saying that that is a very value addition job to mine, no doubt on that. So in that sense, even that is where the SAP also comes into and supports in that function only.
Jain sir, would you like to
Yeah.
add something?
Just to add very briefly, I think Vishalji has dealt with it very exhaustively. But fundamentally, what qualifies for recognition is something that contributes economic value. Now, economic value is not to be sort of economic benefit to the organization is not to be equated with cash flow. Economic benefit can be in terms of saving of costs. And I can give 3 quick examples. A better ERP will result in optimization of inventory levels. It will say facilitate economic order quantity being implemented and so on. It will improve your efficiency in payroll because you will be able to capture and see what assets you have got, because you will be able to monitor your utilization of manpower and so on. So there are numerous benefits that are attached to implementation of ERP, and apart from other things. So therefore, does it result in economic benefit? Answer is yes. And if it results in economic benefit, it should not be equated that does it result in cash flow. Economic benefit is what is the test, and therefore I would agree that ERP can be considered as a intangible asset, because basically it falls within the classification of a asset which is generating economic benefit for the organization.
Yes, sir. Quite true. Any business organization, when they try to take a decision on buying a software or anything, they would surely make an evaluation where if they don't see a benefit there, they won't buy a software. Even in our own company, we do it that way. So any software, if they are going to invest for a huge amounts, they would surely make a cost benefit analysis, and they will ascertain what cost they are saving. Not only inventory, effective management of inventory, even they can save on staff costs, because after ERP is implemented, we have seen in companies the amount of the number of staff also reduced significantly. So there is an indirect benefit that flows to the organization. So from that point of view, there is surely an economic benefit when softwares like ERP are implemented. And any business house, without evaluating cost benefits, none of them will take up any costly softwares and then incur huge expenses. So that analysis is anyway done. And if we see board notes that are put up for board for the approval of the software, it can be clearly evidenced from that what is the savings that they are getting by building that software. So this is how we can conclude whether there is economic benefit accruing to the organization or not. And in several cases that we, in our experience, we have seen there are benefits when an ERP software is implemented, and hence it qualifies to be recognized as an intangible asset. So thank you very much, sir, for answering this question. And we will move on to the next issue on hand. Sir, shall we move on, or you have something to add more?
Yes, go ahead.
Okay, sir. Accounting for leasehold land and application of IND AS 116. Facts of the case are like this. A company is a special purpose public company established by the government of Karnataka, represented by Karnataka Industrial Acquisition and Development Board, or KIADB, and the Government of India, represented by National Industrial Corridor Development and Implementation Trust, or NICDIT. The primary objective of the company is to implement the National Industrial Corridor Program of the government and to develop the Tumakuru node of Chennai Bangalore infrastructure project. As per the shareholders' agreement, it was mutually agreed that the project would be equally financed by both the shareholders, that is Government of Karnataka and Government of India. Accordingly, the KIADB has contributed approximately 1,668 acres of land, and NICDIT has contributed money equivalent to the value of land. Subsequent to obtaining both the land and financial contribution, the company would develop basic infrastructure facilities such as roads, electricity, water, sewage, etc., and provide the same to the industrial units for establishment of factories. A lease agreement for a period of 99 years was executed in favor of the company, and the possession of land was handed over to the company. As per the terms of lease agreement, the lessee was entitled to exercise an option for further extending the lease term for 2 terms of 99 years each. Subsequent to the execution of lease agreement, Government of Karnataka amended the policy for the allotment of land to industrial units and permitted central state joint venture companies to obtain land on lease cum sale basis for a period of 2 years with an option for execution of sale deed either on completion of the project or on the expiry of lease period. Subsequent to the amendment in the policy for allotment of industrial land by Government of Karnataka, tenure of lease agreement between company and KIDB was amended from 99 years to 2 years. The company also intends to register the land in its own name at the end of the 2 years. As the land was obtained by the company on lease from KIADB, lease accounting as prescribed by Ind AS 116 lease was applied, and it recognized both right of use asset and lease liability. The company has opted to disclose right of use asset under inventory as para 47 of Ind AS 116 permits to disclose right of use assets within the same line item in which corresponding asset would be presented if they were owned. Auditor's observation: the right of use asset must be presented as a separate line item on the face of the balance sheet and should not be disclosed as part of inventory. Amortization of right of use asset as per para 32 of Ind AS 116, if the lease transfers ownership of the underlying asset to lessee, if lessor transfers ownership of underlying asset to the lessee by the end of the lease term, the lessee shall depreciate the right of use asset from the commencement date to the end of the useful life of the underlying asset. Given that it is certain for the company to register land in its own name, and as value of equity shares allotted in KIADB is equivalent to cost of land, ROU must be depreciated over the useful life of the asset. As the useful life of the asset, that is land, is infinite, the company has not amortized the right of use asset. The query here is whether the method of presentation of right of use asset adopted by the company is appropriate, whether the accounting policy adopted by the company of not depreciating the right of use asset pursuant to paragraph 32 of Ind AS 116 is appropriate. Sir, I request CA Jayant Gokhale sir to take up this particular issue. Sir, over to you, sir.
Thank you. So I think like the first couple of queries, I must compliment the office for selecting very key decisions that EAC has given, or perhaps almost all the decisions that EAC gives are key decisions. Some very important principles have been brought in, and this is very interesting because if you see that both the auditor and CNAG seem to be in agreement with one point and disagreement on the other. Both are in agreement that it is a right to use asset, and they are both not in sync with each other as to how it should be presented. Now, interestingly, the EAC has taken a view that neither the auditor nor the CNAG were correct in their approach in presenting it as a right to use asset, a right of use. So, in fact, this is typically an illustration where EAC is able to open our minds to a different situation that we must sort of visualize, and how that is done, and why even the chairman mentioned that being part of the EAC actually expands your horizon tremendously. This is one case. Also, it will have importance for the reason that in India, particularly, transfer of title becomes a very complex issue in many transfers of property. But while I cannot say that this is to be applied left, right, and center in all such cases, some of the observations in this case are very important, especially the observations of IFRIC, which I will come to subsequently. So let's look at the facts very quickly. Although Guru Prasad ji has already given the facts on screen, I will just make a mention, if one goes back to the first part, that the Karnataka government agency, that is the lessor, has given the land to the lessee with a very specific objective, and that is to enable industrialization of those areas. And because industrialization does not happen in a vacuum, they have been charged, that is, the lessee company has been charged with developing the necessary roads, lighting, water supply, infrastructure, etc. for this. And very importantly, they have been given the right to create such other rights in that property. So the land basically belonged to the government. Through the government, it has come to a government agency, which is mentioned in that, the KIADB. From there, it has been given on a 99 plus 99-year lease to a querist company. The querist company does not intend to hold it ad infinitum. The querist company wants to use that land to develop the infrastructure and pass it on to corporates. Now, therefore, the concept of inventory, right to use, etc. comes in, because they are only the lessors. The lessor, the original lessor, they are the lessees. The original lessor, that KIADB, has put a very interesting condition that they will execute the sale only on the happening of two things. It's there in the details that have been provided to the EAC, that at the termination of the lease term, which could be 99 years, or on the project being completed. Project is what? This use of the land for industrial purposes. Why is this condition put? We will again come to. So, at the point of giving it, and that is why at the initial stage, because it was a lease, the company treated it as a right of use and therefore accounted for it in a certain manner. The only dispute seems to be the presentation. But perhaps the government itself recognizing that if you allow them 99 years, some of the development may not take place for 99 years, because the lessee, the querist company, then has no interest in development of that area at a fast pace. So what they have done is that they have amended the terms to say that you will have the right to get a effective sale implemented in 2 years' time, provided you have completed the terms of the project, which means that you should hand over and promote industry in that area. So these facts are very important. So, and it's a large area, 1,668 acres of land, which this SPV has been given. Now, if you look at all this, we do not go retrospectively, and EAC has also not gone into it, that what was the correct method 2 years ago when in 21 the land was given, etc. I think whatever is the year under consideration, the agreement for having that change from lease and sale reduced to a period of 2 years has already been executed. That is also presented in the detailed facts of the case. As a result, what has happened is that EAC, in its observations, has come to a conclusion that effectively, and there I would cite some of the paras that EAC has cited, what they have said is that the option of execution of sale deed, either on completion of project or expiry of the lease period. Now, expiry of lease period would have been 99 years. Now, that is brought down to 2 years. Now, the test becomes, when does that get completed? Possession has already been handed over. And therefore, the company has, of course, opted to disclose it under inventory. The dispute between the CNAG and them were on the point as to whether it should be inventory or not. But what is interesting to observe is the observations of the expert advisory committee in that regard. And I will draw your attention to particular paras of the IFRIC that has been mentioned. So what the IFRIC mentioned, and there is an interesting other observation, I'll come to that in Ind AS 116, but I will first go to the observations of the International Financial Reporting Standards Committee, which gives certain basis of conclusions in the IFRIC. So what they have said in Expert Advisory Committee makes a mention of that in the para BC 78, which EAC has quoted. It starts by saying a long-term lease of land is sometimes regarded as being economically similar to the purchase of land. Now, this is a very important statement, that effectively it is economically similar to the purchase of land. And I'll not go into the details, I've already mentioned some of them, that considering that virtually all rights were vested in the Querist company, they could create encumbrances, they could sublet, they could give rights to other companies and so on. Effectively, the ownership had been transferred. And the intention was that the Querist company would then create, assign that to certain companies who are setting up projects in that area and so on. So there they looked at as something that they would acquire on lease and then give on sublease. That is how the Querist had looked at it. The crux of the issue is that since it is going to be treated as similar to a sale, then the property is virtually that of the Querist company, and therefore there is no just right to use. It is practically a property of the company itself. Then we come to the second aspect of the company. So first aspect which the EAC has considered is that it is not a right of use, and therefore, very interestingly, and this is mentioned in the the concluding para of the opinion, and I'm reading from there, that as discussed in para 15 above, the requirements of Ind AS 116 will not be applicable on this arrangement, and the question of presentation of right to use and amortization of the same does not arise. So they have flatly ruled out the applicability of Ind AS 116, and I entirely support that view. I was, of course, party to that. So this is the logic. One will have to go through the opinion in detail to understand that if you want to apply it elsewhere, but I would say that this is a very important part. Then one comes to the second part. One looks at it, is it a property? Answer is yes, because you have acquired virtually all rights. Now, does property necessarily fall under Ind AS 16, or does it go, it is not falling under Ind AS 116 is clear. Can it go under Ind AS 2, which is the inventory, which is what the Querist is saying? But the EAC has come up with a third option, which is to say that it is actually they have said that it is an investment property, which is a subset of property, plant and equipment, but a property which is acquired in order to generate future cash flows. Because what is envisaged is, either you will take that property, now you have already taken the property from the KIADB, you have already taken the property. Now the question remains, are you going to give it on lease for long lease of 99 years to the industrial company concerned? Or are you going to say that I am giving it on shorter tenures in order to generate revenue cash flow for myself by way of an investment that I have made that investment and now I'm going to get cash flows out of it? So the issue would then be, can you show it as inventory? Can you show it as property, which is yes, but is that property part of investment property? Now, this was never envisaged, never considered. I'm making a distinction between the first part, that EAC only answers the question that is asked. But a further point we must add is that if you go by a wrong methodology, EAC will bring out the appropriate methodology. And here it has said it is not necessarily, it is certainly not investment, it is certainly not something to which Ind AS 116 will apply. They've said Ind AS 2 could apply. Theoretically, Ind AS 16 could apply. But more appropriately, the uh, the investment property Ind AS 30 would apply, and that is why the concluding part of the opinion actually mentions that, and again, very importantly, that the concluding part of the opinion mentions that, sorry, Ind AS 40, I wrongly mentioned Ind AS 30. The company, depending on its own facts and circumstances and intention to hold the land, intention is very important over here, should comply with the requirements of Ind AS 2 stroke Ind AS 40 in regard to land under development as discussed in para 17 above. So I think the important aspect that I would like to highlight in this opinion, which I felt was very important, is that the facts are very important. Sometimes queries actually don't disclose all the facts, then EAC takes time. And as Devashish ji mentioned at the introduction, EAC tries to be very fast, but if facts provided are not adequate, then we have to go into various cycles to get the facts. But once the facts are fully taken into consideration, EAC will give you the right answer. And in this case, they have shown that even though there is not even a whisper about applicability of either the aspect of investment property in the query, nor about applicability or otherwise of Ind AS 116, the EAC has opined on both these matters in order to show the correct method. And also they have incidentally commented on the issue of amortization, because that is a part of the question asked, that since you say that this is property which is effectively owned by the querist, then since land has got an infinite period of time, there is nothing wrong. There is no question of right to use which will depreciate over 99 years or 2 years. No, it is a property practically owned by the querist company, and therefore question of amortization does not apply, or amortization or depreciation, since it is classified under immovable property. Even if it is immovable property, it can still go under inventory also if they are intending to trade in that property, and therefore question of amortization or depreciation would not arise. All these issues have been nicely dealt with in the opinion. I believe it's very comprehensive, and I hope I have been able to bring out all the facets of it. Thank you.
Vishal sir, if you would like to add a few points on the issue.
I think Guru Prasad Gokhale has already well explained all the peculiarities in detail. In fact, the points which were not even raised by the querist and EAC has come to a correct accounting treatment. Now, only I think on one or two questions, but just I would like to add. Now, in this case, obviously, there was a lease followed by a purchase option, but EAC said that it is in substance purchase of the asset. My only thing is, see, it was a very fact-specific decision. Now, in many other leases where it's a long-term lease and after a long-term lease, there could be a purchase option available. Now, those cases, one can't really say that in all those cases, it is as good as purchase. And in fact, India's 116 leasing standard also deals with the scenarios where there could be a purchase option and how to deal with it. So in this case, actually the intent of both the parties as evidence from 99 years to lease getting reduced to 2 years, and similarly government coming up with the policy of allowing the companies to purchase and there will be no consideration on the purchase. All these were indicating that it is purchase for all substantive purposes. It is not a lease followed by the purchase option. So I think that differentiation, when one is looking at the specific facts, will be very important, which one has to really look at it and carefully analyze and see that when India's 116 is applicable, when it is not. And as I think even IFRIC or ISB has already said in basis for conclusion, while accounting may not be materially different, but definitely the leasing contains a lot of additional disclosures, which one should not miss out for by just saying that it is plain vanilla PP. So I think those differences has to maintain. And finally, the point which was there and which EAC has clearly not dealt with because it was not raised. I think those points are also very important. In this case, the point was that at what value it has been recorded, because it was given by one of the shareholders as shareholder contribution, while one shareholder brought in money, other shareholder gave land, kind of in-kind contribution. So now should it be, and that shareholder is also a government. So is it some element of government grant? Should this land be recorded at nominal price? Should it be recorded at fair value? And consequently, how the share capital will also get recorded and share premium, etc. Those issues obviously have not been dealt with. Those are the practical issues which one will have to look at it in a real life scenario. So I think that was the only point which I had. Others, Gokhleji, I have already explained. Over to you, Guru Prasadji or Gokhleji, to add further.
Thank you, sir. Sir, the very important aspect that Jain sir has brought out is the aspect relating to facts by which EAC has concluded that there is as if there is a control of the land passed on to the company. So effectively, since all the control of the land has been passed on to the company, EAC has concluded that in substance it is transfer of land only, it is purchase of land. And then whether there, again, sir has explained very well, whether it has to go into Ind AS 16 or Ind AS 2 or Ind AS 40. 16 is out of question because company is not using it for its own purpose. Now then, in this particular opinion, institute did not say that 40 has to be applied or 2 has to be applied. There, since facts and circumstances play a very important role, institute has said that in spite of all that they have dealt with, they have come out with the solution that it can be Ind AS 02 or it can be Ind AS 40. So there, if it is Ind AS 40 or Ind AS 02, it is the intention of management which determines the fact whether it goes as an inventory or it goes as an investment property. The intention of the management is to rent those properties to industrial units and companies. For rentals, if it would like to hold a portion of land, then that portion will become, investment property, and Ind AS 40 compliances would come into play. But if the entire parcels of land, if the intention of the company is to sell them away, then it goes into inventory. So in both cases, EAC did not conclude saying that this is 2 or this is 40. It said that facts of the case have to be further judged, and then intention of the management has to be evaluated. Only then we can come to that conclusion. But it has very clearly ruled out the applicability of Ind AS 116. It has turned the picture around, and then it said that it is not Ind AS 116 picture that you have to look at. You have to look at Ind AS 2 and 40. This is a wonderful opinion, which is very interesting one to deliberate upon. And both of you have elaborated well. So if there is nothing else to add, we will move on to the next issue, sir.
Sure.
Yeah. The next query that we have is consolidation of financial statements of Section 8 company. Facts of the case: a company incorporated under Companies Act 2013 as a Section 8 company limited by shares, hereinafter referred to as Section 8 company or the sponsored company, has its equity contribution from a listed entity, hereinafter referred to as the sponsor company or the company. The Section 8 company was established in the year 2021 with its main objects being inter alia to undertake, promote, engage in carrying out, encourage, sponsor, aid, subsidize, or assist by making donations, charities, contributions, or providing financial or any other assistance, directly or indirectly, in respect of activities pertaining to various objects. The directors of Section 8 company are Mr. G, also Chief Executive Officer of the sponsor company, sorry, and Mr. M. The operations of Section 8 company are carried on independently under the oversight of its board of directors. Till 31st March 2023, sponsor company has consolidated the financial statements of Section 8 company. Memorandum of Association of Section 8 company clearly states that the profits, if any, or other income of Section 8 company shall be applied solely for the promotion of its objectives as set forth in this memorandum. No portion of its profits, other income, or property aforesaid shall be paid or transferred directly or indirectly by way of dividend, bonus, or otherwise by way of profit to persons who at the time are or have been members of Section 8 company, or any one or more of them, or to any person claiming through any one or more of them. No remuneration or other benefit in money or money's worth shall be given by Section 8 company to any of its members, whether officers or members of the company or not, except payment of out-of-pocket expenses, a reasonable and proper interest on money lent, or reasonable and proper rent on premises let to Section 8 company. Nothing in this clause shall prevent the payment of Section 8 company in good faith of prudent remuneration to any of its officers or servants not being members, or to any other person not being member, in return for any services actually rendered to Section 8 company. Nothing in clause 3 and 4 shall prevent the payment by Section 8 company in good faith of prudent remuneration to any of its members in return for any service actually rendered to Section 8 company. Keeping these facts in mind, company wishes to reassess whether Section 8 company needs to be consolidated with sponsor company or not. Control evaluation as per Ind AS 110 consolidated financial statements. Currently, the company does not exercise any control over Section 8 company. The company only contributes funds to CSR purposes to Section 8 company. Oversight, if any, is only to the extent of sponsor having requirements and reporting from any NPO organization to whom funds are given to. Up to liquidation of this Section 8 company, the proceeds should be given only to another NPO. Upon liquidation of the Section 8 company, the proceeds should be given only to another NPO which is in same objects of philanthropy. Therefore, as per the queryist, in the absence of any commercial benefit flowing to Section 8 company, the company cannot consider it as a control. The company is engaged with Section 8 company through its equity holding only. Due to Section 8 company's registration framework, it is explicitly prohibited from allocating any rights over its profits to its members. Consequently, there is neither exposure nor entitlement to any returns from the investee. In addition, company lacks right to variable returns as there are no such entitlements specified. Given the absence of these rights, the company is unable to leverage its influence over the investee to influence returns. The query basically is about whether the company which is listed entity is required to consolidate financial statements of its sponsored company, which is Section 8 company registered under Companies Act 2013. If the answer to the above is negative, whether it can change the position taken for preparation of its financial statements till March 23. So this basically the issue is whether if there is a Section 8 company sponsored by any listed entity and consolidated financial statements become applicable, whether Section 8 company financials have to be consolidated into the sponsor company or not. So this is the issue on hand. I request Vishal Bansal sir to take up this issue and deliberate first. Thank you, sir.
Yeah. Thank you, Guru Prasadji. And again, I think a very pertinent issue because potentially many companies may have such Section 8 companies or may have set up. Now, in this case, a listed company has set up a Section 8 company to meet its CSR obligation. Now, obviously, it's a company. The company has put in the share capital. It is the single shareholder, and it is contributing the money. And ultimately, the company in which there are two directors, which one of them is the CEO of the company, and there is another director. They are saying that they make the decision and to carry out the activities, etc. And I think the key point which the company was making or the querist was making, that the money, whatever has gone to the Section 8 company, cannot come back at all to the company. It cannot pay any dividend, it cannot return the capital, it cannot pay any remuneration. Obviously, if there are some service providers, to them they will make payment, but it cannot make any distribution or return capital and or contributions, etc., to the company. So there is no according to a case, there is no benefit to the company from this company, and consequently they were saying that should there be a consolidation or should there be no consolidation, and that was the matter. I think in this case, obviously, as Guru Prasadji has said, that it is assumed that consolidation requirements are applicable. Obviously, listed companies, if they have any subsidiary the consolidation becomes applicable. And even if it is concluded to be a subsidiary, even then consolidation becomes applicable, because it is about any subsidiary, associate, or joint venture. The consolidation becomes applicable. Now that is one. Second is, now one has to also look at the scope exclusions. IFRS 10 or Ind AS 110 has certain scope exclusions, like it gives exclusion for trusts which are constituted for employee benefits and which are accounted as post-employment benefits under Ind AS 19, because you are doing post-employment benefit accounting and related disclosure. There it is not applicable. Consolidation is not required. However, like in ESOP trust, there is no exemption. Now, so in this case, there is no specific exemption for a CSR or for a not-for-profit company, so you can directly apply a scope exclusion. Now, so which means one will have to really go through Ind AS 110 criteria in terms of evaluating whether there should be a consolidation or not a consolidation. And so or is it a really a subsidiary or not a subsidiary? Now, if one goes through Ind AS 110 from a consolidation perspective, it lays down broadly three criteria to evaluate control. One is power, second is variable return, and third is the linkage between the power and variable return. Basically, the same person should have a power and a variable return, and consequently, one should and able to use that power to return impact its variable return. So these are the three criteria. Now, in this case, when the committee looked at it, I think the question which was primarily coming was that the querist is talking about the benefits from the company, which is more to do with variable return. Hence, it needs to be focused more. That is what the EAC looked at it, and obviously that was the focus area. But obviously, EAC also said that for a completeness, and I think from a general perspective, one should look at all three criteria. Now, if I have to talk about the power first in a sequential manner. Now, the power is coming normally from the rights. Now, in this case, if one was to really look at it, the company has set up this trust or Section 8 company. It has defined its purpose, that what it will do, how it will do. Ultimately, being a single shareholder, it will have the right to appoint and remove the board. Who, if not the company, who else can do it? Okay, it is a single shareholder. Its CEO is sitting there as the director of the company. It can change those directors. It has defined objectives, and obviously presuming that all those rights are there with the company, because there is no one else in the picture. So it seems pretty clear that there is a power which the company exercises over this Section 8 company. Now comes to the variable return. And variable return, obviously, the querist contention was that I don't get anything out of it. I don't get dividend. I don't get my capital back. So I have no real economic benefits to it. And I think that's where Ind AS 110 and its equivalent IFRS 10 with the basis for conclusion becomes very important. And if you go through, or one goes through these documents, they have very clearly articulated that the stand, unlike earlier in AS 21, Ind AS 110 or IFRS 10 defines a return in a much, much wider way. Now, in fact, when the standard was getting formulated, ISB has also looked at it, whether the return should be limited to a financial return in terms of dividend or capital back, but they have clearly rejected. They have said that return is a very wide meaning. And in terms of return, they have even said that it could include even non-financial return, even a reputation risk to the company, that the company not, that is also a return. And second thing, they also highlighted, which is emerging from the standard, that return need not be a positive return only. It could also be a negative return. Okay, or it could be a positive or a negative return. So overall, the question when one is looking at the return, one should not look at it only in terms of capital return or a dividend return. It has a much wider meaning. Now, if one was to look at this and apply in the facts of the case, the company has set up this to meet its legal objective of ensuring CSR compliances. If the trust was not to work, function properly, its legal compliances could put a question, exposing it to a legal risks. It could again, CSR is also of larger companies looked at closely by the analysts, by the public, by various regulatory and other agencies. It could definitely also pose a potential regulatory risk. Many times, obviously when you are doing CSR, it also somewhere adds the kind of quality of the activities which one does, also adds some bit of brand value. So there is, while it doesn't give any return in that sense, but definitely considering the reputation attached, considering the CSR compliance, and so on and so forth, there is a return. But that's what EAC concluded, and I think to my mind that's a fair conclusion. Now, considering that and obviously all these returns, the company is managing through its power. So consequently, there is a linkage between the power and the return. So ultimately, considering all of these aspects, the EAC concluded that there is definitely a control in this case, and it should be consolidated. I think, and obviously, see in this case, because the way facts were coming, the EAC concluded, and I would specifically like to highlight it may or may not be there. So in all the cases, and obviously, in some cases, it could also be the different fact pattern, and those need to be really looked at it. So I think that was the important conclusion on control of Section 8 company. Now, one aspect which EAC has rightly so put it in the disclaimer paragraph, not looked at it. Let's say if you are to consolidate Section 8 company, then what happens the next? Okay, there will be obviously CSR obligations, etc. Now, how will you account for that? If I have to take a simple example, let's say there is a company who has set up a Section 8 company, assume consolidation. What they do is that at the year end on a 31st March, they have a CSR obligation and they pay the money of, let's say, 10 crore to Section 8 company, and that money is lying in Section 8 company as a cash. They have not spent anywhere. I'm just taking a simple example. Now, consequently, when you consolidate the trust, cash comes back to you. And similarly, that money also comes back. So does it mean that CSR expense needs to be reversed in a consolidated financial statement and cash equivalent goes up? Now, EAC has not dealt with it. Now, to my mind, one has to look at, and obviously EAC has drawn a reference that one has to look at the other standard. And to my mind, obviously, one has to apply the standards in entirety at consolidated financial statement. And one of the standard which becomes relevant is obligation standard, which is more, I would really say, it could be a legal obligation, it could be a contractual obligation, or it could be a constructive obligation. And specifically to highlight, under Ind AS even 37, even constructive obligations need to be provided for it. So considering that one needs to be look at it, is there an obligation at the consolidated group level to spend that 10 crore, which would normally be there. And if that is the case, so while cash is coming back, but profit or net worth may not increase because the group will still have an obligation to spend that 10 crore on CSR activities or transfer it to the fund, etc., etc. So that additional obligation may come. Okay. Similarly, in my view, while one is doing consolidated financial statement, this cash which is coming also need to see from its nature perspective as per Ind AS 7. Is it in the nature of cash and cash equivalent, or it is some restricted cash, and how should it really be presented? And again, this could be a very specific evaluation which are not dealt with, but once one start consolidating, it is not a simple matter of saying one line by line consolidation. It is one has to look at all the standard, and I mind it under Ind AS 110, line by line consolidation is just a starting point. One has to apply all the standards again, including in this case like Ind AS 7, Ind AS 37, and other relevant standards in a more detailed way. So I think very important opinion, and the implications could be much more than what it really appears, but one has to look at various aspects carefully. I would request my fellow panelists to add their perspective if they have any further perspective to add.
Yes, I think, of course, very interesting query. I would just add that, some of these problems lot of companies that I have seen, here the difficulty apparently arises because there is 100% equity holding by the parent company is what is given in the facts. A lot of the companies, perhaps in order to avoid this situation, create the Section 8 company as a guarantee company, whereby the aspect of shareholding goes out of the picture. Then, of course, control comes in. Whether one wants to retain control, not retain control, bring in other persons, is what then the entire set of facts get changed. So I would only say to the listeners that where one is having the option to structure such a thing, one needs to consider the consequences. Although I believe that a literal interpretation of the standard and the principle-based interpretation of the standard can give different interpretations. But the safer view is that if one has a company, Section 8 company, let's say company A is the holding company, it incorporates a CSR implementation company as a company limited by guarantee and not by shareholding, then the test of shareholding goes out of the picture. Then the test that really applies is whether you have control, and that effective control can, if the intention is that way, can be diluted. If the intention is to control, then obviously all consequences will follow. So this is just a practical thought that I thought I might contribute. Other than that, I would not want to add anything more. Thank you.
Thank you very much, sir. The opinion when the question is being raised, and then when we start reading out all the objections that the company is raising, why it cannot have a return, and then why there is no control by the company on the Section 8 company, it looks as if it is quite true that there is no control. But when we read the opinion, the way which they have bifurcated everything, and then going by clause, how power can be proved, how there is a variable return is really very nice and interesting to know. In this particular case, I think the crux is everything that they have said it is not there is there because it has been shown in a different way by EAC. Power is there because it is basically the CSR funds of the sponsor company, and the sponsor company has a requirement of certain activities to be conducted, so that they would administer to this company. And since it is 100% owned, then its directors can be appointed by this company, so it can control and it will control the operations of that particular company. And variable return also, it is very nicely dealt in. It cannot be a return in terms of cash flow to the company by way of dividend or any return, but there can be a negative impact on the company, on the reputation. And if there is a failure on part of Section 8 company, then there could be a certain legal or penalties on the main company. So there are certain losses which the company would incur if Section 8 company does not perform in the way it has to perform. So on the flip side of it also, we will have to see the returns have to be interpreted in that way also. That is how this EAC opinion has been brought out. And Vishal sir has very nicely explained these two aspects very much. It is not whether control is there or not there apparently, but from the other angle, it has been very clearly shown in the opinion that control does exist, and also the variable returns do exist. And then since control is there, consolidation is required. So since there are no questions on this particular topic, we will move on to the next opinion. Though we have two more, I think the time that we have, there is a constraint. So we will only be taking up one more opinion. Sir, if there is anything else you would like to add, otherwise we will move on to the next opinion, sir.
You can move to the next opinion, sir.
Thank you.
Yeah.
Classification of provision for doubtful debts no longer required return back as other income or other operating revenue. Facts of the case: a company is a mini Ratna company. The core activity of the company has been divided into two operational divisions, that is e-commerce and trading. The company had made a provision of doubtful debts amounting to rupees 94.89 crores in earlier years, against which it realized a sum of rupees 18.23 crores from the customers during the financial year 2022-23. Balance amount of rupees 76.66 crores was considered as bad debt and charged to profit and loss account, P&L account, and entire provision for doubtful debts amounting to rupees 94.89 crores was credited to profit and loss account under the head other income. Auditor's view, since trade receivable is the amount to be realized from customers in normal course of operation, the writing back of provision against trade receivables should also be shown under other operating revenues instead of other income. Hence, this resulted in overstatement of other income and understatement of other operating revenues by rupees 94.89 crores each. Management's view, although the trade receivable is the amount to be realized from customer in normal course of operation, but provisions made against the bad and doubtful trade receivables and subsequent realization thereof, if any, cannot be termed as part of normal course of operation. Realization of trade receivable and write back of provision cannot be termed as similar activity. Also, the operating income comprises of amount related to operations in a particular operating cycle, which in the instant case is limited to the financial year 2022-23. Furthermore, the figures of rupees 76.66 crore is appearing on both sides of statement of profit and loss, that is income and expenditure, having no effect on profitability, thereby having neutral effect. For this, inclusion of cited amount in current year's operating cycle as other operating income will not reflect the true picture in the financial statements. The query is whether provision no longer required written back can be classified as other income or other operating revenue. So this is the topic we are going to discuss, and I request CA Jayant Gokhale sir to take up this particular opinion.
Yeah.
Over to you, sir.
Thank you. I am also keeping a watch on the clock, so I think we've got just a few minutes. So participants will excuse me for rushing it a bit, but I assure you that I will not take more than a few minutes, because this is one of the relatively simple, although interesting query. Because again, in this, like the last one that I discussed, if you see the question asked is that whether it is right to be shown as operating income or other income, other operating revenue or other income. The answer that the expert advisory committee has given rightly is that it is neither, in the sense that that is not the way to approach the problem. And this is what is interesting for all viewers to understand, that sometimes some fundamentals are missed out. I'll not go into the details, but I will draw your attention to two important statutory provisions which the expert advisory committee has relied on. One is that para 82BA of Ind AS 1 is very, very explicit, which says that any impairment gains, losses and their disclosure should be as a separate line item. See, after Ind AS has come in, this concept of bad debts written off, etc., has actually gone off, because these are, in a sense, financial assets, receivables. Even the definition of receivables is there. Reference is made to what is receivable without any reservations as per the legal agreement with debtors, and so on. But without getting into the details, Ind AS 1, para 82BA, I'm just giving a reference. You will go through it, you will understand. And more importantly, even more explicitly, the Institute's own guidance note on the subject, which the EAC opinion refers to, is very, very specific in this regard, that it says that so far as this item, para 82, as I said, I'll just read out one line: impairment losses, including reversals of impairment losses or gains, determined in accordance with section 5.5 of Ind AS 109. The profit and loss section of the profit and loss should deal with it. And then the guidance note on division 2 Ind AS schedule 3 is very specific that such separate line items should be included in the profit and loss section. And therefore, this argument, which may sound logical, that we are actually netting it out and it really does not affect and zero impact on profit and loss, does not carry any weight whatsoever, because a wrong presentation is a wrong presentation. So whether you show it as other income, other operational revenue, and I would just like to add on my side that if you see carefully the provisions of Schedule 3, the other income includes 5 specific categories. 4 are very specific if you fall within them, or it says other operating revenue. So other operating revenue actually goes as a part of other income. It's a separate line item which is mentioned. So EAC has given a very simple opinion: follow the law, follow the guidance note, and that's about it. So I'll not speak more on that. Vishalji, if I missed out something, please go ahead and mention. Otherwise, I don't want to take up more time on a seemingly straightforward question, except for the fact that the question asked was, is it income, other income, other operating revenue? It is neither. It is a impairment loss. And another last point I must mention, an impairment gain could also result. This was debated extensively in the EAC committee. And if there is an impairment gain, it is still mentioned as to how it is to be put in Schedule 3, and it should be presented as a negative figure under the head impairment, because impairment fundamentally comes on the debit side of profit and loss. You can show a negative figure over there, but you cannot show it elsewhere. That is what the EAC concluded. Yes, Vishalji, any further points to add?
Yeah, I think Gokhale is fairly summarized, and as you have rightly said, it's a relatively simpler opinion. The only thing I think I will, if I can explain quickly with an example. In this case, let's say the company has created a provision of 100 in the previous year, and there was a recovery out of 100 for 20 in the current year, and consequently there was that was definitely an impairment reversal, as you have rightly said, and 80 remaining 80, because they have become bad, that was being written off. Now the querist was saying that even that 80 will be shown as an income, and 100 was shown. So if entire 100 was shown as a reversal of impairment, and 80 was shown as a write-off as a separate expense. Now the EAC has actually put the number to say that in this case the 20 is only the impairment reversal. So you should be showing the way you have presented only 20. You can't gross up notionally that 80 more reversal and 80 write-off. That is not there. Normally, whenever you sell the asset, you calculate gain or loss as difference between the carrying amount and the selling price. Now, in this case, there was a 100 rupees provision, out of that 80 is written off. So that is not again an income and expense. That is just a write-off of already provided amount. So that was the only additional perspective which I thought one should bring it out in this case.
Right.
Thank you, sir. Thank you very much. The opinion is pretty simple. It is just saying stick to the basics. Sometimes in CA exams, we prepare for a very tough paper, and then the paper turns out to be very easy. We don't tend to write well. So here the topic is very simple. It is only impairment loss and impairment loss reversal, and standard clearly states, also Schedule 3 clearly states how it has to be presented. So it is a very simple one, but yes, it is important because sometimes we miss the simple things. So with this
Also before you conclude, Guru Prasad ji, I may mention, because I've had many years of experience in the expert advisory committee. When we start answering a query thinking it is simple, I have found from experience that the discussion takes not less than 4 hours and sometimes spreads over many meetings. So the apparently simple questions have got many hidden facets in them, which I'm just bringing to attention of the viewers, that never consider something simple when these are accounting issues of complex nature. There is always some hidden bomb underneath. So be very, very careful. Yes, sir. Back to you.
When EAC gives an opinion, it looks very simple, sir, ultimately. That is how EAC makes things simple. Yes.
No, there is one phrase. I know we are overshooting. Genius lies in making difficult things appear simple. That is what a quotation is. So genius, when he does something, whether it's a cricketer hitting a boundary or taking a catch, if he's a genius, it looks very simple. You try doing that, you will fail miserably. So similarly, what EAC does is genius. What appears to be simple is actually the result of so many geniuses sitting over there. I am happy to be sharing the table with some of them at some time.
Thank you, sir. Thank you. Nice words. I am also immensely grateful and feel privileged to be part of the committee of such learned members, and also headed by a person like Dr. Debashish sir. And I hand over the proceedings to the office. You can conclude the webinar, madam. Thank you very much.
Thank you all for joining today's webinar. We appreciate your time and engagement. We want to extend our gratitude to the speakers of the webinar, C. Jayan Gokhleji, C. Vishal Bansalji, and C. Guru Prasadji, for steering today's webinar. The views expressed in the panel discussions were insightful and gave guidance on many relevant issues. The opinions discussed are quite relevant to almost all entities, although these are facts and case specific. They explain important principles of these standards. We believe that the deliberations at the panel discussion will be of immense help to the participants. We assure to give the benefits of EAC expertise in future as well. Thank you very much.
Thank you. Thank you.
Thank you.
Thank you.
Thank you.